Hello, good evening. My name is Boris Sapozhnikov and welcome to the webinar. Today we will speak about the all-in-one mortgage. As many of you know me, I am a mortgage professional who works across all of Canada, so all information provided here is valid in any place where you live from west to east coast. So I would like to start with disclaimer. This information is made available to you as a self-help tool, and it's just as a presentation is just to get general information. Unfortunately, I cannot give through YouTube channel in any investment advice, and I cannot guarantee this information accuracy according to your personal circumstances. So I'm encouraging you to seek personalized advice, and I will be happy to help, or any mortgage professional who works with all-in-one mortgages. Okay, so let's start. Let's start with kind of general topics, mistakes that we make in our everyday life. Why I would like to start with this before to speak about any financial issues. A reason why I want to start with this because we are going to switch how we are thinking about mortgages. During this webinar, we will try to understand absolutely different concept. And why people don't like, even myself, don't like to learn anything new, it's mostly because of inertia. What do I mean by inertia? We prefer easy, simple, and prefer not to do any action in our life. We like routine. We like to follow a routine. If our mortgage comes to renewal, we prefer to renew it. We can obviously look for better rate, but we rarely look on maybe different type of mortgages. And inertia is a killer, because when we are not looking for new opportunities, we just continue to do whatever we did before. Mainly, we are not considering readvanceable mortgages at all. And what is a readvanceable mortgages and how they work, we will speak during this webinar. We are not really looking on future plans when we are closing our mortgage for 5 years or 3 years or whatever. We're rarely doing this. We should be honest. We mainly considering our existing lender, or we are looking for big banks, and we strongly believe that they help us and working for us because we have their checking accounts, saving accounts, and TFSA and RSP accounts. So we naturally believe this is, so if I will open so many accounts with my bank, they definitely will give me the best mortgage in the world. And unfortunately, it's not true. And we are really focused on interest rates, and today the main topic, interest rates is going up, what will happen, but not always interest rates is the main part of the mortgage. And this is what we are going to learn today. It's how this interest rate charged. It's how and what we can do when we have these problems with interest rates. We mainly waiting until the end of our term before we are renewing, and it's also one of the mistakes that many of us doing. For example, if your term is coming in April and you never try to renew several months ago, it's obvious mistake. Why? Because interest rates are today, or even in May, will be much more higher than they were several months ago. So we never should wait until the end of the term. We should do mortgage check, and I'm personally doing mortgage checks to my clients yearly. And another thing, we are usually not negotiating fees. Whatever fees banks giving us, we are living with these fees. So we need to negotiate fees. So this is a kind of general mistake myself and many of us doing on everyday life, and I wanted to put accent on this mistake before we will start to speak, because I'm going to change our mind. I'm going to try to change our mind. I'm going to try to understand totally different type of mortgage, and let's move forward. But before me moving forward, I just want to ask you, you have a live chat here. So we have a live chat here. So you can use this live chat to ask any questions that you may have. And please don't hesitate to ask. And if you believe that your question is too personal, so just keep this question to yourself, and we can discuss it later over the phone call or over the Zoom or whatever you prefer. Okay, so let's move forward. Let's start with something basic idea. I know many of you already know, oh, simple interest, compound interest, everyone's speaking about it, but I want that we will look on numbers before I will move forward with explaining a concept of all-in-one mortgage, okay? And like today, I spoke to my son, and he is in high school and he's learning financing, and when we discuss the simple and compound interest, I got feeling they're not really learning in deep this in the schools. They may learn some math about it, but they're not really learning about concept, and they don't really understand in deep a huge difference between two ideas, simple and compound interest, and how we should use it in our everyday life. So let's start with the simple interest. Calculate simple interest, very simple. Taking principal, let's say $10,000, like taking interest 5%, so 0.05, term, let's say 2 years. So we just multiply 10,000 by interest by term, and I got here $1,000. So in 2 years, if nothing happened, if I'm borrowing $10,000, I should return $1,000 as interest and $10,000 because I borrowed for $10,000. Okay, in total $11,000, but interest in just $1,000. Very simple interest. So what's the difference with compound interest that everyone's speaking about compound interest? And I will take not compound interest that compounding monthly or weekly because it's too complicated. I will take compound interest like mortgage interest. So compound interest or mortgage interest compound twice. The meaning of this interest compound twice in the year, in the middle of the year and at the end of the year. So basically, if I have 2 years, I have divided these 2 years into 4 parts. Half year, another half, half, and another half. So in total 4 halves, 0.5. You can see this right here, 0.5, 0.5, 0.5. And how is calculation done? So $10,000 times the same interest, 5%, times half year is $250 of interest. Now, what happened next? This $250 of interest added to the original amount, $10,000. So $10,250 now multiplied by 5% and by another half year. Now we come to $256.25 of interest for this half of year. So I need to add this to the previous amount, 10,250, and the next step I have 10,506.25. Multiply by same interest and multiply by another half of year. So what I try to show here, so instead to pay $1,000 in 2 years, I will pay $1,038.13. And you maybe will say, it's 5% interest. Why everyone doing this big deal about it? Like simple interest, and compound interest is not really huge difference, $38. I can live with it, especially if it's about the mortgage. I would like to remind you that it's just $10,000. Okay, so for $100,000, it will be $380 instead of $38. And when we are speaking about $500,000 mortgage, so it's 380 times 5. So it's already more than $1,500. So this compound interest affects much more harder and stronger than regular interest. And let's leave $10,000, and I want to show one more example. What will happen if I will leave this $10,000 for 25 years? At the end 25 years, interest for simple interest will be just $12,500. But compounding interest, it will be $24,371.09. And it's just about $10,000. And if it's $100,000, we come to the amount $240,000. So basically, if my mortgage just $100,000, just $100,000, I believe no one who is in this webinar doesn't have $100,000 mortgage, but if yes, you are lucky. So let's say you have $100,000 mortgage, very small mortgage. Interest in 25 years compound on this mortgage will be $240,000. So almost 2.5 times more than original amount, and it's just interest for $100,000. So compound interest play a very strong role here, and if we understand this principle, we should be easily understand everything what I am going to speak today. So simple interest is a small interest. Compound interest is big or much more bigger. So if I'm going to invest my money in somewhere, I will look where can I do and use compound interest, because I want that my money will grow if I'm investor. But if I'm borrower and I'm borrowing money, I should avoid compound interest. And how can I avoid compound interest in Canada? Every mortgage in Canada compound twice in a year, and it's law. It's not optional. It's not that I can come to the bank and say, I'm really good client, please do different. They will not do different. Any mortgage in Canada compound twice in the year. So what can I do? So we have solution here. According to the law, instead to take a mortgage, I can take HELOC. And what is a HELOC? It's Home Equity Line of Credit. Very long name. Let's just use HELOC, much more easy. HELOC, it's you borrowing money and you need to return just simple interest. No compounding here. It's very straightforward, simple interest borrowing. If you take any mortgage, you should use bank or any lender will use compound interest. So what is easier to pay off? Of course, easier to pay off is HELOC. What is the faster to pay off? Of course, it's faster to pay off is HELOC. So if it was so simple, why I'm not going to the bank and not taking HELOC that will cover 95% of my home and take 5% down and take HELOC 95%? Unfortunately, according to regulatory rules, we are not allowed to take HELOC so high. So we kind of stuck to take a mortgage. But if you're borrowing just 65% of total of the cost of your home, just 65%, all the 65% can be a HELOC. So basically you can borrow 65%, put everything in a HELOC, will have simple interest, not any compounding. You can save a lot of money on simple interest. Of course, many of you may say, oh, if I will put anything on HELOC, and somebody who knows how the line of credit works may say, oh, I may basically pay just interest all my life and never pay down my money that I actually borrowed. Yes, and this is unfortunate. So some people not using this properly, like just borrowing and not returning back. But again, if you have installed mortgage and if you have HELOC and if you have two options and you have a strong discipline, or like I will say even average discipline, financial discipline, HELOC is much more preferable. Why? Because you will save a lot of money on interest costs. And I'm not speaking about what is interest in total interest cost. So it doesn't matter what will be actual interest, 3 or 5%. Sometimes you can overperform or you can doing better if you have HELOC even 4% and someone has mortgage the same size with 2%. And I'm going to show many examples today, but before I'm moving forward, I want just to do quick look, maybe some questions here. Okay, I don't see any questions. Again, I encourage to ask questions. I really hope that concept of simple and compound interest was understood completely, because before I am moving to the next step. Okay, if you hesitate, keep your questions, write them down. I will give time for question and answers at the end of my presentation as well. Okay, so let's move forward. Okay, so how it works, how all-in-one mortgages works. Basically, your home is kind of 100%. So you need to create equity in your home, at least 20%. This is what marked by black right here. So this part, unaccessible part, it's something that you cannot access. So before you want to move to all-in-one mortgage, you need to make sure that you have at least 20% equity. And it's kind of equity that can come just because price is going up, or it's because you pay down your mortgage and you have 20% equity. Okay, so sometimes people say me, oh, I just took mortgage 2 years ago and I took this 10% down payment, so I'm not sure, maybe I have 20%. So you have a high chance that you already have 20% equity, not because you paid down your mortgage, just because prices increase during the last 2-3 years. So 20% of the home non-accessible. We are going to speak just about this 80%, and we are going to combine mortgage together with HELOC. Why we must to combine mortgage together with HELOC? Because as I said, according to the law, you cannot have just a HELOC. If you have 35% of equity, you may build just HELOC only mortgage or HELOC only borrowing. But because we have 80% here, we must combine mortgage together with HELOC. Now, how to divide HELOC and mortgage? How many percent put on HELOC? How many percent to put on the mortgage? Division, or how we divide our mortgage or money that we're borrowing, depends by cash flow. And what is a cash flow? If you don't know your cash flow, you can do a homework today and calculate your cash flow. If you're lazy and you want me to calculate it for you, I can do it. So basically, how I am calculating my cash flow or any one of my clients. I am asking to bring me anything, like all transactions from, if the family have one checking account, it's very easy. If family have several checking accounts, so you need to look on several checking accounts. But if family have just one checking account, I'm looking in focus just on checking account. I'm asking simple question: if all transactions going through checking account, and in case if some transaction going to some different accounts, I need to clarify this as well. But if it's simple family, usually all transactions going through the checking account. So I'm looking everything that in on this checking account and everything that out from the checking account. And some banks even presenting to their clients cash flow. They are showing what is was in, what is was out, and what is the difference. And I'm looking at least for 3 months, sometimes looking for 6 months if I need more details, but 3 months it should be more than enough. And so I'm looking how much money in, how much money out, and if money in more than money out, it's a normal standard financial behavior. Is much out more than much money in, so it's abnormal financial behavior, and all-in-one mortgage is usually not for this type of client. So if you have normal, like if it's 3 months, maybe last 3 months was difficult for you, you had more out than in, it's okay. So maybe we need to look on 6 months, or maybe we will need to look for 1 year, maybe we'll need to look on average for 2 years. But usually I prefer to look just for last 3 months, because most recent behavior really reflect what is the person and how he is behaving. So I'm looking how much cash in, how much cash out, and if cash in much more higher than cash out, like cash in much more higher than cash out, my HELOC can be bigger. If my cash in very close to cash out, in this scenario sometimes depends what is the differences. Maybe I need to keep lower or smaller HELOC and bigger mortgage. Again, it depends by interest rate in the market or whatever client is eligible to pick. Next step. Okay, before I'm going to the next step, quick check. Good explanation. Okay, thank you very much. I got kind message. Continue, encourage me. I love when people encouraging me. Continue to ask questions, or just send me smiling or different messages. It's nice. Thank you very much. Let's continue. Okay, so how it works, we want to understand. So I have 20% untouchable, forget about it. I have HELOC and I have mortgage. HELOC in all-in-one mortgages, it's also checking account. So if I got a paycheck for $1,000, okay, I'm working somewhere and I earned $1,000, okay, it's standard bank transaction. My employer send me $1,000 check, or let's say I have children and I got from Canada child benefit $1,000 check. Doesn't matter from where to comes this money. What is important, it comes to my checking account. And my HELOC in all-in-one mortgage, it's a checking account. So it plays two roles. So this brown HELOC money is borrowed money, and $1,000 entered to the HELOC. Immediately, at the same second when they entered, they stuck there, and my HELOC smaller. So if, for example, I borrowed $100,000, when $1,000 entered, $99,000 right now in the HELOC. I'm speaking just about HELOC, forget about mortgage. So I am paying simple interest, again, not compound. I want to avoid compound. I'm paying just simple interest, and just for $99,000. Why? Because my HELOC was 100 minus 1, 99,000. So basically I am starting immediately as my check come to my account, I started immediately at the same moment to pay less interest. And let's say I'm not using this money, not today and not tomorrow. Simple interest calculated yearly and divided by 365 days. So basically today, because my check inside, and tomorrow I'm not going to use this money, and maybe another day I'm still not going to use this money, all these 3 days I'm paying not $100,000, not interest on $100,000. I'm paying just interest on $99,000. So I'm paying less interest. And think about people who has a different sources of income, and think about the family who has husband and wife, and they get money from their jobs, okay, or they have children, they get money from Canada Child Benefit. So all this money, they are going to the checking account, and we start automatically pay less interest on our HELOC because it's blocked. HELOC much more smaller at this moment when money in. What happens when we need to pay for something? Time to pay $500 for the mortgage. Okay, why payment so small? $500. Let's say it's weekly payment. Okay, we don't have to pick weekly payment. We can use monthly payment, bi-weekly payment. Let's say this family wants to use weekly payments for some reason. They want to pay mortgage much more faster than others, so they trying to accelerate. So they picked instead to pay 400 something 500, but it's just as illustration example. Okay, so time to pay $500 for the mortgage. What happened? $1,000 divided, and I don't need to do this. Okay, everything computer doing this inside of my HELOC, inside of my all-in-one main account. $1,000 will be divided, $500 still there, and I still continue to pay interest only on the rest of the HELOC. So another $500 I need to pay for the mortgage, but my another $500 still reducing the interest that I pay for HELOC. Okay, so in not just several days I was paying less interest. Now even when I need to pay something, even part of my money inside of the HELOC that I'm still not using inside of my checking account, working hard for me, reducing interest that I should pay on HELOC. You can't get this with any account with any bank. All-in-one or real all-in-one system, it's checking connected with HELOC, so you don't need to run to the bank and do some transfers, or from checking to HELOC, oh, I forgot to do it today, oh, let's do it tomorrow, oh, I did it at the 6 p.m. at the evening, oh, it's already all transaction past time, so I don't really, my transaction today at after 6 p.m., it's not really affecting this day, so just affecting another day, and I'm losing money on interest. This is what happened with normal or standard HELOCs with any banks. This is how banks or any lenders making money. But all-in-one giving us this option. It's not even option, all-in-one, it's automatic system that already checking, and HELOC is basically the same thing. They're not separating this. Okay, so your main account, or call this checking account, or call this HELOC account, it's the same place. Okay, so again, $1,000, like I will go back. So $1,000 on HELOC, several days, pay less interest. Divided to 500, 500. 500 going to the mortgage, 500 goes still on HELOC, pay less interest on HELOC. Not only this, next step. inside of this $500, okay, let's say $250 is interest on mortgage. I just divided it on half because I don't want to do complicated calculation. I wanted to do this simple, okay? So we had $1,000, half of this 500 still in the HELOC. It's yellow, okay? It's kind of here. Oops, sorry, I have to go back. Okay, so $500 here in yellow, still working for us, working very hard. We pay less interest because 500 is still here. 250 going for interest on mortgage because I did $500 mortgage payment, and $250 going toward equity, and it's going straight on the top. So remember, 20%, this is some kind of equity that I cannot touch. Now I have here additional $250, and this $250, it's not just simple by green color. It's accessible money. It doesn't matter where you take your mortgage, with any big bank or small banks or medium banks or any online banks. If you're doing mortgage in standard way or even some kind of complicated way, when you pay down your equity, this money there, this money locked there. Even if you have variable rate mortgage, in order to pull out money that locked on your equity, you should pay penalty. Even with variable mortgages that it's very small penalties, you still need to pay penalty to access this $250. It's your money. This $250, it's not bank's money, it's yours. But bank locking this. It's your equity and it's locked there. And in order to get access, you need to wait or until the end of your term or pay penalty. And if it's under 5 years fixed, penalty will be much more higher than this $250, but it's your money, you want to get access, you cannot. But with all-in-one mortgage, you have access. Do you want to take it? Take it. You can reborrow it back, and it will appear as additional HELOC in your account. So let's go back to all this concept. So I have mortgage, HELOC, and mortgage. I'm getting money, doesn't matter from where. This money sits there, I'm paying less interest. My mortgage works hard, my account, all-in-one account works hard, my money works hard, I'm paying less interest. When I need this money, or bank need to take this money for any payment, credit card, mortgage payment, or doesn't matter what payment, they take it automatically. When it's mortgage payment, it's always divided by two parts. One part is interest, another part is equity. As soon as I pay equity, it's automatically accessible for me. So not only I pay less on interest because it's not compounded, it's simple interest, and some of my money holding and helping me to pay less on HELOC interest. Also, I have now access to the cash that I paid before, and I can reborrow it back. When I want to reborrow equity with any other lender, remember, you need to pay penalty or you need to wait until the end of your term. Okay, I want to check if maybe any questions here. Why lenders would allow all-in-one if it's less profitable for them? Okay, it's a great question. Why lender will allow all-in-one if it's less profitable for them? They allow this not everywhere. Actually, if you go to the bank and will ask for all-in-one, They maybe will say, oh yes, we have all in one. You go to RBC, they say, yeah, we have all in one. You go to National, they say, yes, we have all in one. You go to the Scotia, they say, yes, we have all in one. A true, they don't have. They don't have all in one. Why? It's exactly because what you asked me, because it's not profitable. Because much more profitable to have kind of all in one. Okay? So basically, regular bank, they don't want this concept. They don't want that you will borrow money and put them under the HELOC. This is why in Canada, we don't have HELOC that you can take HELOC 95%, because if you have option here in Canada to take HELOC 95%, you were taking this because it's simple interest. You are not allowed. Only if you pay down 35% of your house, or you have down payment for your new house 35%, you can take, instead of mortgage, you can legally take just 65% HELOC and just pay simple interest. This is why so many law from here comes, law from there, this federal regulations, this, because from one side they want to help us make housing more accessible. From other side, they understand that economics should run and banks should make profit. So why anyway, some kind of lenders may decide to create this system. Actually, today I'm speaking about the lender who was one of the first in Canada. He was the first who introduced this concept. Others saw this concept, and of course they understand financing, and they say, oh, I don't want this. I don't want to lose money, so I will create under the same name something similar. People will go and will buy it from me, and I will still make money because it's not actually works as it works with this specific lender. And the lender's name is Manulife. This is a lender who actually created this system. And Manulife, of course, was not the first one who introduced the system, but it doesn't matter history. We need to learn how we use our financing today, and I don't want to speak about the history. So, is it profitable for bank? No. Banks or any lender in any way will try to avoid you to use this system. Why Manulife allow you to use this system? Because this is their concept. This is an idea. Why anyway, how they profit from this idea? They profit because they get perfect customers. Why they get perfect customers? Because if somebody looks on this concept, it's too complicated. And usually what I said at the beginning of my presentation, inertia. Because of inertia, we are going to the standard lenders. We don't want to put too much thoughts and understand this concept. In order to use this concept perfectly, we need deeply understand this concept and feel this concept. Okay, so I will be happy to see more questions in the way. So again, and I want to move next. Okay, so what we should understand until this point: at any point of time, we can access equity. And basically this equity, it's your emergency account. A lot of people, financial gurus say, oh, you should save money and put it somewhere and it will be your emergency account. It's really easy to say, but for many of us, it's really hard to do. Much more simpler if it will be kind of system that will be created. So in case if I have emergency, I have access to this money. Yes, I'm borrowing this money and I will pay some interest on this, but it will be not some kind of high interest. For example, I have a car, I need another car, I go to the lender, I go to the dealer, they say me I need to pay 4% interest or 5% interest. Maybe they will give me 2% of interest. So if I will be lucky, will get 2% interest, I probably will take it, but maybe I will not be so lucky. And my interest on car will be 5%. And honestly, I met clients that they have 20% interest on the cars, 15% interest on the cars. And all these car loans is of course compound interest loans because they want to make profit. It's not simple interest. So even when I am taking loan for the car under 2%, it's compound interest. And I need to calculate what is overall interest cost for this loan for this car. Because maybe if I will take this money from my accessible equity, even under 3.3%, it may be even better because why? Because it's a simple interest. So my emergency account under the simple interest, not compound. And I can pay just interest. I can return it whenever I want. It's under my home. Now, any income, it's in yellow here, lowering interest cost. Anything that entered in the HELOC immediately starting lowering my interest cost at any point of time. And main idea of all this, keep the money in the HELOC as long as possible. So what do I mean by this? You have a credit card, you need to pay it, you have pay period, you have a date when you need to pay a credit card, pay your credit card day before and you will be fine. If you need to pay your credit card twice, do it. But I'm personally not recommend it. It's not helping, not with credit score, not credit history, not helping with anything. Okay? Keep your balance low on your credit card and pay it once in a month. This is all what you need know about credit cards. So basically, if you get the money from your job and it's in the HELOC, it's lowering your overall interest costs. And when you take this money from the HELOC and paying your credit card, it's basically, and you pay it in the last minute, so you can win all this time in between, so you lowering your interest costs. Again, we have a home, 20% not accessible. As long as you pay down mortgage, we getting accessible equity, we can reborrow and do whatever we want with this. Every income that entered in the HELOC, where is our checking account, or basically HELOC is our checking account, lowering our interest costs, and we basically paying down our mortgage faster than with any other lender. Okay, I'm going to check any questions. I don't see any. Perfect, I go forward. Just an example. Just one of the examples that I discussed with one of my clients. So they had balance on mortgage $500,000, a value of home $700,000. They have interest 2%, very good interest rate. We already forgot about this interest rate. 2% is really hard to get. They pay mortgage payment $2,118. And after 5 years, they should have $418,000, $51 at the end of the 5-year period. All interest costs for 25 years, around $135,000. Okay, I checked what is the cash flow with this family. Remember, money in, money out, money in, money out. We checked average for several months. This is what we found, $1,482. If they apply all in one account under the HELOC, look, HELOC 3.3, mortgage rate 3.64, and actually today I have mortgage rate much better than this one. We just recently used for our client 3.19. So I'm taking, in this example, purposely very high interest rate. So mortgage, instead mortgage of 2%, HELOC under 3.3, much bigger. Mortgage rate, even bigger, 3.64. This client winning, ending balance in 5 years, $305,000. Look what's the difference. Difference more than $100,000. It's crazy. So if this client will stay with his current lender, he will end with equity around 80,000. This is what equity he will make in 5 years. But if he will move to the all-in-one, he create almost $200,000 in equity that he may access any day, any time during all these 5 years. Interest cost, much more cheaper in this case as well. More than this, interest cost in 15 years, $123,000. So with this plan, all-in-one plan, this client, instead to pay mortgage for 25 years, will end to pay mortgage in 15 years, 10 years early. I know, it's shock. When I first saw these numbers, when I first started to learn about all-in-one, I was shocked. Because why people not speaking about it? Why not everyone in this account? It's not easy to get there. Why? First of all, this is what I spoke. I started my presentation. I started my presentation with word inertia. This is what killing everyone, and not only Canadian, it's like all around the world. People naturally have certain style of life. Their parents had certain style of life. Their grandparents had certain style of life. They're teaching their children also certain style of life, and move from concept of, oh, lower interest rate is better. No, not lower interest rate is better. Simple interest is better than compound interest. This is 100% true. In this example, I can see that 3.64 is better than 2%. Isn't crazy? It's like boom. When I first saw these numbers, I was not believing, but when I did more deeper research and I understand the math behind this, and I try to introduce this math at the beginning of this presentation, and I hope you understand this concept. When you borrow money, you need to borrow with simple interest and no lender giving you. You go to borrow money from any place, they always put it under compound. You borrowing for the car, compound. You borrowing with a credit card, compound. If borrowing for mortgage, compound. Every lender doing compound. Only one place where you can get simple interest is line of credit. And the best one is the HELOC. Why? Because it's under your house. It's secured line of credit or home equity line of credit. This is the most cheapest one, simple interest credit. I spoke here briefly about RSP loans. I mentioned that RSP loans, usually if you take it RBC, you need to take loan at RBC and you invest with RBC. You take loan in TD, you invest with TD. Here with all-in-one concept, you borrow with Manulife and you go and invest anywhere. Do you like TD? Go with TD. Do you want BMO? Invest with BMO. Do you prefer to invest with Wealthsimple or anywhere else? You can do whatever you want. Use any provider. This is why it's good to borrow if you want to borrow for RSP loans with Manulife. Now, next. Non-registered investments. Non-registered investments may be very useful. Again, you don't need to get any approval for this loan with Manulife. You take amount from your equity, you invest in any non-registered investments anywhere in the world. with any available provider, pay back on your own timeline, and you can build tax deductible mortgage. And this is what you can do with all-in-one, to build tax deductible mortgage. Okay, I want to introduce here and just do a very short introduction here to the Smith maneuver. Okay, I'm not going to teach Smith maneuver, I'm not going to do presentation about Smith maneuver, but I'm going to show why all-in-one is good for Smith maneuver. So basically here we have a home, okay? 20% of the home not accessible. I have accessible equity that I can borrow money from there. I have incomes that come to HELOC. I pay less interest. And I can create tax deductible mortgage. How? Let's say I have $2,200 monthly mortgage payment. Let's say $1,200 goes to interest and $1,000 go to the principal. I can borrow this $1,000 that goes to the principal because it's in the accessible equity at 3.3%. I pay interest of the current month and it's $2.75 from $1,000, and the rest $997.25, it's money that I'm taking and invest in non-registered investments. This money that I borrowed, creating area that called tax deductible mortgage. So $997.25, it's a new type of mortgage that I created under my home, and this tax deductible mortgage. And why it's tax deductible mortgage? Because I borrowed money to invest in the economic. I'm helping economic, and government of Canada allowed me to get tax back because I'm investing and helping economic. This called Smith maneuver. It's totally separate concept, and we can do presentation on this and speak hours about it. But this is why many people take all-in-one mortgages and use them to create, instead of regular mortgage, tax deductible mortgage. Okay, thank you, Arkady, for letting me know that we are good now. And I will continue. Okay, so what is the idea of Smith maneuver? Idea that you slowly you change your house from this structure to this structure. The main idea is that you have accessible equity, that some kind of cash that you always can reborrow, and all this part is tax deductible mortgage. And when your income is come here, you can do with this whatever you want. And tax deductible mortgage, all mortgage tax deductible, and you get money back from the government. Why? Because you invest. So from once, just imagine this, like many of us paying down mortgage and waiting to the time when we able to invest, because we don't have free, like any cash to invest now. Here with this type of structure, we can every time reborrow and invest, reborrow and invest. And remember, when you invest and you invest in compound interest, your interest grow high, you're making much more money on compound interest. But you're borrowing from your HELOC, so you pay back simple interest. And on this simple interest that you pay, because you invested, government pay you, because this is tax deductible mortgage. Win, win, win. We are winning because we are investing early. We are not waiting to pay down mortgage and invest after. Like among a lot of financial gurus say, oh, pay down mortgage, like and start to invest. Here in all-in-one concept, you can create inaccessible equity emergency fund. It's basically where you can get money if something happens. You create tax-deductible mortgage, and it's 100% legal here in Canada to have tax-deductible mortgage and get money back on interest that you paid for your mortgage. At the same time, money that you borrowed from your more equity somewhere making compound interest and your money growing. Win, 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 win. You can say me, but I still own my house in kind of under the mortgage. Yes, but at some point when you will sell all your investments or some of them and pay down this tax deductible mortgage, your investment will be much more higher because their interest, your investment interest, under compound interest, and you borrowed under the simple interest. And not just you borrowed under the simple interest, you got also money back from the government because you borrowed under simple interest. Again, win, 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 win from all directions. Many people like to say, my home is my fortress. My home is my fortress. And here's, by my personal opinion and many financial advisors' opinion, I'm not financial advisors, again, I'm a mortgage professional. As my personal opinion, as a mortgage professional, and as the opinion of many financial advisors, if you live here in Canada, your real home is your fortress if you're 20% paid down long time ago. You have accessible equity that you can access anytime if you need for any emergency. Your income going to your HELOC and reducing interest that you pay, and you have more in HELOC, so you pay more or borrowing more as a simple interest. You're converting your mortgage to tax deductible mortgage, so you're getting money back from the government on your borrowing. So you're helping yourself, you're helping country because you're investing, you're preparing yourself to retirement, you have investment accounts, you can always sell these accounts, or if you don't like to invest in market or you're afraid, you can purchase another home and rent it out. But it's totally different story. Okay? But it's also kind of Smith maneuver. Okay, so before I start to speak about I just checked that no questions here. Okay, so what some lenders and mortgage professional can do for you. So pay or reimburse legal fees, discharge fees, appraisal fees, title insurance fees. So pay attention on all these fees, and when you work with a mortgage professional, ask if some fees can be reimbursed. Okay, so how to start? If you decided to go with this process, I recommend you set a clear financial goal and speak about it to the mortgage professional. So just call me and ask and speak and discuss with me what is your goal and what do you want to do. We clarify with your current lender outstanding mortgage balance if you already have a mortgage, mortgage payments, frequency, interest rate, current term, and what it started, amortization period, prepayment penalty if it's in the middle of term. If you're purchasing, go and ask what lender will give you, what will be term, what will be amortization, what will be interest rates, and we will check. Maybe it's better to purchase with all-in-one. So basically, I'm always saying, you don't have just jump in the idea and use it. First of all, start with any lender. When you already with some lender, check what is the best what they can do for you. And after this, give me a call and I will show you what all-in-one can do for you. In 90% of the cases, all-in-one better than your current lender, even if your interest rate is better there. Why? Because you can decrease your interest cost by using simple interest. So a key here, simple interest here. Okay, so it's the time for questions and answers. If you have any questions, answers, I will be happy to hear. I will just about a minute. I will wait about a minute. If any questions or answers you may be here. Okay, thank you very much and see you soon.